What I'm going to do is now just hand you over to Tony Tollington. He's our reader here. He's a reader here at Brunel Business School, and he's going to take you through this evening of our seven deadly sins of financial accounting. Thank you.
Thank you. Everybody, and welcome to Brunel and this fantastic, brilliant new facility that we've got. I don't think you'd choose anything better, could you really? What prompted this paper, which I know a number of you have picked up, is my concern over what was happening in the banking sector, and to be absolutely blunt, my ignorance about it as well. And I have no problem with ignorance. It's the failure to remedy ignorance, which I think is the issue. So I've written this paper. It's only finished about 2 weeks ago, and if you've got any comments on it, by all means send them to me. I would appreciate it. So I don't have all the answers tonight. And hopefully you may do. So if that's the case, great, contribute. There'll be a question and answer session at the end of it. And I'll certainly obviously give it my best shot. The lecture split into two parts. The first part deals exclusively with fair value and the subjectivity that's associated with fair value. And then it looks at the fair values of the underlying assets associated with financial instruments. And we start in the second half of the lecture to look at that, what's happening in the banking industry, and try and get some understanding there. Okay, so it's quite controversial. Should be fun, I hope. And the question and answer session will be lively, but please don't look to me for all the answers. I will certainly do my best, but I am seeking some understanding. And you see this quote behind me? I think if you don't understand, then you have to try and find out. And once you've found out, try and do something about it. And I think there's a moral imperative that you should find out. I think there's a moral imperative that if there is something wrong, that we do something about it. Now, my own view is this, from the brief studies I've done in this area, is that the accounting profession is complicit in what I believe is probably the biggest fraud perpetrated in the history of mankind. And that's a very provocative statement to make. I'm not sure it's absolutely true. I'd certainly welcome your opinions on it at the end of this evening. But if that's true, that quote from John F. Kennedy really counts. So what I've done is I've written a paper. It's a very unusual paper because the paper is entitled The 7 Deadly Sins of Financial Accounting. This is a rather emotive title in its own right. And it uses allegory, use of symbolism to convey a deeper moral meaning. And usually, certainly hardened academics will say, well, forget morality when it comes to hard-nosed academic papers. So this is a bit unusual. There is allegory in the academic literature, but not much. And it's an expose, the act of bringing a scandal or crime to public notice. And I'm going to be focusing in the second half on the banking sector in particular. Let's use the clicker. Here's a picture. It's a picture by Hieronymus Bosch. Mid-1500s, I believe. It's painted on wood. Rather weird thing. You've got a picture of Christ in the middle, and around it you've got 7 pictures of the 7 deadly sins. It's a visual representation. And the question I'd ask in accountancy, well, we do representations. We call it a faithful representation of financial reality. And we use slightly different tools. We don't use paint, but we do use numbers to represent our version of financial reality. But it is only a representation. So in the same way that we can paint the 7 deadly sins, we do it. We can paint a different picture. And this evening we're going to be doing it by reference to words. What you have there is a picture of a pupil. It's said to be the all-seeing eye of God, and at the bottom there you've got a Latin description which says, "Beware, beware, God sees all." Right, so it's quite sort of doom and gloom stuff. Here's a question: is the Hieronymus Bosch painting a faithful representation of sinful behaviour? So when you look at that allegorical representation, is it a faithful representation? Well, I look at the picture of Christ in the middle, and I think it's rather weird that he's stood like that, but there we are. It's one form of representation. And the next question: is the accounting representation of financial reality a faith one? In the same way as Hieronymus Bosch was trying to represent it in pictures, we represent it to repeat in terms of our financial statements. And we can legitimately ask, is this a faithful representation? Now, my own view is that when we start to use fair values, it gets less representative. It's quite a controversial statement, and I'll develop that. And the reason why is we've added to transaction-based accounting a more valuations-orientated approach towards accounting over the last few decades, not many. If you go back 500 years, you had some mad monk called Luca Pacioli who is accredited with inventing double-entry bookkeeping, and it centres around the 5 basic elements of accountancy: asset, liability, expense, income, and capital. And it's a very robust system. It works on the principle that if I buy, you must have sold, and if I receive your money, you must have given it to me. And it stood the test of time. It's very much a craft-based practice, and it's robust. It works. It's been tried and tested, and it works. And a large part of accounting for many, many centuries was geared around transaction-based accounting with a few rules attached to it. But more recently, we've migrated, not so much aware, as I said, we build on this transaction basis to actually now have a more valuations-based view of accountancy. And you can argue that we've moved away from the reliability associated with the transaction. As I said, it's a robust structure, stood the test of time, tried and tested, to one which is now taking into account valuations-based view. And the arguments we've moved from a position of reliability to one of greater relevance. And we've sacrificed perhaps a little bit of reliability to get more relevant information out there. And the accounting profession is caught in quite a dilemma, really, because, yeah, okay, transaction-based systems are very reliable and robust systems, but they date very quickly, they get historic. And people look at the information and say, it's not relevant, it's old hat. So the accounting profession has responded to that to produce more relevant information. It happened probably about from the 1960s onwards. I remember reading a paper by Robson where the accounting profession, he used the word, has become investment signifiers. We've moved beyond the pure bookkeeping and into practices like valuing companies and so on, where we need more relevant information, and we therefore move into the area of valuations-based approach accounting. So I'm going to take you through 7 sins, first one being wrath. Give you time to read it. In the 2008 financial crisis, accountants largely avoided any criticism. The major criticism I actually found in the literature was about pro-cyclicality, which is essentially that when you've got declining asset values, reporting those declining values tends to exacerbate the value decline. But nobody really picked up on the subjectivity of valuations. Most of the attention was focused towards the volatility in the banking market and the fact that it was collapsing. The accountants couldn't be held responsible for their financial products because the bankers were doing that, and they couldn't be held responsible for the volatility in the marketplace. So they largely escaped liability in that sense. But in the literature, when you look at it, there are references to the fact, well, okay, we've escaped it this time, but will we escape it necessarily next time? And here we have a quote from the Financial Reporting Council. They are clearly concerned, or they wouldn't have written this in their latest audit report. And that concern goes further. So that's the regulatory position. They are worried, in my opinion. And not only was this comment in 2012-13, but it goes back as well, previous 2 years. So they're not fools, the accounting profession. They're aware of it. And they need to keep a very careful eye on it. And they're very concerned about this wonderful word, professional skepticism. We've got some amazing jargon in accountancy, haven't we? We really have. I call it prudence, really, but there we are. They call it professional skepticism. We've got This quote by Raymond's, good paper. It's cited in the back of the one that you've got. I'd recommend that you read it. And he says the concept of profit as value change is unsatisfactory even in an ideal world. So he's not mad keen on reporting value changes. And we've got that, haven't we? In the IS1 statements, we're now reporting not only profits from an operating cycle, but also reporting unrealized gains from holding assets in our comprehensive income statement. So we really have moved from the old-fashioned realization and only realization to moving towards now changes in valuation. Here's a contrary view. Somebody's obviously very keen on the reliability afforded by transaction-based accounting. It goes further in saying that's probably more useful to reporters, and you can see that from these two comments are actually reflective of quite a volume of literature, academic literature, which is very unhappy with what's happening in terms of the subjectivity associated with fair value. So the last three slides you've had the top regulatory body, which is Financial Reporting Council, and then a couple of comments which are actually just giving you tasters of the objections which are being raised in the academic literature about the use of fair values. So I put this slide in because towards the second half of the lecture we're going to actually try and make this link between what you're getting from me now in terms of fair values in general to the specific context of looking at banking. So what is the attraction of an economic mark-to-market value, or in accounting terms, the fair value? We're looking towards the marketplace to establish the value of our assets. And we move on to the second sin, the sin of envy. An envious eye is cast towards the economics domain. We look at market-based values, we want to use those market-based values. But conceptually speaking, it's a bit of a dog's breakfast. If you go into the academic literature dealing with conceptual frameworks, you'll read rather extensively the failure of them, the functional failure of them in principle. There's an excellent paper, I don't know whether I've cited it, I think I have, by Michael Page, which likens the search for conceptual framework to the hunting of a snark, a mythical creature. We never quite get there. So we are at the moment in the process of changing our conceptual framework, but the ISB is not learning anything from what is actually in the literature extensively about the functional failures of conceptual frameworks. And it's quite a bold statement to make. And the reason is that we look to the economics domain, maybe with an envious eye, if that's the way you want to look at it, and we're looking for market-based values, but the conceptual foundation to accountancy is quite eclectic. It's more than just economics. So we draw upon these terms. If you look at the latest discussion paper on the conceptual framework, these terms are there in abundance. And few lessons are being learned from history about the functional failure of the conceptual framework. I find it very interesting, digressing slightly, that I think I'm right in saying that fair value first hit the accounting standards in IS 39 about the late 1990s, and then it fed out into the other standards, and then in 2011 we got IFRS 13, where we have the three types of fair value, so now we've got a specific standard on fair value. And then more recently in 2013 we now got a discussion paper on the conceptual framework, which obviously has fair value in abundance in it. Think about it. We put it in accounting standards, and I can remember at that time we weren't even too sure. We talked about, what was it, arm's length transactions between willing parties, and we weren't too sure whether we were dealing with input values or output values, replacement or realizable. It's now realizable. So it's established. But at that time, I can remember there was extensive debate, and I remember scratching my head and thinking, well, why is it in the standard? We rolled it out of the standards, we rolled it out then into FRS 13, and we're now trying to roll it out in the conceptual framework. Stop. Shouldn't it be the other way around? Shouldn't you lay the conceptual bedrock first, then look at disclosure, recognition, measurement, and we take the measurement bit and we say it's going to be fair values. Let's create FRS 13. FRS 13. And then once we've got FRS 13, let's spill that out into the other accounting standards. Instead, we just go ahead and do it. So it seems to be that we put the cart before the horse in the way we actually implemented this as well. Okay, so let me go back to that before we do move on any further. We are a muggle profession. Mungles, if you like. Might upset a few people, but what I mean by that is that our heritage is not a pure conceptually based heritage. It's one based on law. Certainly 500 years ago, transaction-based, legalistic transaction-based was what drove the reporting of figures. We now have a very heavy economic orientation towards the marketplace in the use of fair values. So we've now got the mixture of the two. But it's also a very political profession. And I've just described one way in which the politics is being exercised in respect of IS 39, rolling out the standard, then doing FRS 13, then trying to develop a conceptual framework. It's the reverse way round to me. And that's the way it should be done. It's also socially responsible profession, so there are social dynamics as well. So the conceptual foundation of accountancy is very eclectic. We are casting our eye quite enviously towards one domain, the economics domain, looking for market-based values and the mark-to-market measures. And it's an incomplete picture. So let's look for lust. Okay, good painting. Okay, and what do we mean by lust here? Lust of accountants towards economic market-based values. And what I'm going to do is an analogous setting looking at a beautiful woman. What else when you're dealing with lust? We adopt a market-based values, so-called level 1 values. So if you go to IFRS 13, there are 3 levels of measurement. This is the first one. And this is the second one. And this is the third one. So you have 3 possible measurement bases. It's interesting in its own right, don't you think, that we actually have 3 types of measurement. I mean, we never will get away from mixed measurement bases in accountancy. And we have to accept that when we're comparing assets and assets, we really are comparing not apples and pears, but baskets of fruit to baskets of fruit. And I think you have to accept in that process that you hope that you're not looking at a tropical fruit salad versus an ordinary fruit salad. But we have mixed measurement bases as a feature of accountancy, and there will always be a mismatch because of it in terms of comparisons. So, to go back there, we adopt her, we emulate her, we flatter her. What else do? We use similar language to her. And these are terms which are resonant in the new discussion document on the conceptual framework, but they're commonplace, aren't they, throughout accountancy? So we use the same economic language. We try to adopt a style by showing that accounting figures are aligned to the marketplace as a whole body of literature, dealing with what's called value relevant studies, which is trying to say that we, in the accounting figures, produce a value relevant information. There's an association, a statistical association, established between the accounting numbers and what the market is then reflecting in terms of value. It's a whole body of literature called the value relevant studies. If you want a good summary article, then there's one by Holthausen and Watts in 2000, which will give you a very good summary viewpoint. But we try our best to argue the case that the accounting figures have some bearing upon the marketplace and vice versa. And finally, we think in concepts like comprehensive income based on Hicksian economics. The IS1 statements now have realizable values and changes in unrealized values. And the concept behind it is a change in wealth. I think the Hicksian definition is something like a change in wealth plus consumption over a period of account. And so we're very much now moving to what Raymond was saying, we're looking at profit as a change in value. But her fidelity, in my opinion, has to be seriously questioned. So, yeah, we're after market-based values. Why would we question her fidelity? Isn't she true to us? Well, let's look at the first bit. When she goes missing. It's the case that for a lot of figures, there are no market references. You simply have an entity-specific value, which is established at the entity level, and you can't look to the marketplace because there isn't one. Level 1, you can go straight to the marketplace. Level 2, you'll be able to look at something which approximates to it, and level 3, it's marked to model. But it may well be that even a model doesn't fit, and you're dealing literally with an entity-specific transaction. So, when she goes missing. The second one, when she behaves badly. I've got 2 examples here. There's an excellent book by Robert Schiller called Irrational Exuberance, and it gives all the reasons, all the human reasons, why market volatility will occur because of human factors. Things like the impact of advertising and how people respond to it. Things like just simply herd mentality, that they're jumping in, we'll jump in, and which are driving changes in markets which are quite volatile. And if you're looking for price equilibrium, well, it's going to take a long time to settle. And the second point is about, which is common and leads on to the second half of the lecture, where we're looking more at banking industry. I think there's a strong argument now to say that, well, these markets, which are supposed to be freely operating markets, are increasingly being manipulated. So if we're looking to the economics domain, we're looking to market-based values to establish prices established by price equilibrium. It's being corrupted. Do I lust after her? No ways. I think this headlong pursuit towards a more economic orientation, this headlong pursuit towards a market value-based orientation is a road to ruin, personally. Raymond suggests that in his paper when I read it, that we should actually have 2 columns, one for transaction-based reporting and one for valuation-based reporting. Not a bad idea. If memory serves me correctly, I think Edward Stamp many decades ago recommended the same sort of thing around the discussions around inflation accounting back in the late 1970s, early 80s, where you get both. Okay, so can I justify that? Do I lust after her? No way, she might cheat on me. In what way? Oh, great. It's collapsed on me. Sorry about this, folks. 1 minute. Let's try again. Do you want to turn the volume up? Go for it.
Everybody knows the dice are loaded. Everybody rolls their fingers crossed. Everybody knows the war is over. Everybody knows the good guys lost. Everybody knows the fight was fixed. Poor stay poor, the rich get rich, 'cause that's how it goes. And everybody knows. Everybody knows the boat is leaking. Everybody knows the captain lied. Everybody got this broken feeling, like their father or their dog just died. Everybody talking to their pockets. Everybody wants a box of chocolates, or alongst them roads, 'cause everybody knows, everybody knows the bankers screwed us. Everybody knows they don't steal. Everybody knows that they truly greed money back on all of their swill. Everybody asks where the accountants. Everybody knows they in the tube. Financial stew, cooked without a clue. Everybody knows, everybody knows where the banker goes. Everybody knows, everybody knows, everybody knows he's on his tiptoes. Everybody knows. Everybody knows it's now or never. Everybody knows it's me or you. Everybody knows you live forever when you've done up your line or two. Everybody knows the deal is rotten. Old Black Joe still picking his cotton for your ribbon and your bow, 'cause everybody knows. Everybody knows the plague is coming. Everybody knows it's moving fast. Everybody knows the naked man and woman are just a shining artifact of your past. Everybody knows the seed is dead. There's gonna be a meter upon your bed that will disclose what every banker knows. Everybody knows the cure of trouble. Everybody knows what you put us through. From the bloody banks within the city to the beaches of Malibu. Everybody knows it's coming about. Take one last look, the sacred heart, before it flows. Now everybody knows, everybody knows, yeah, everybody knows where that banker goes, standing on his toes. Everybody knows, everybody knows, 'cause that's how it goes. Everybody knows, everybody knows, everybody knows, 'cause that's how it goes.
Okay, you had a lot of examples there dealing with how the market's being manipulated. We're relying on markets to establish price equilibrium necessary to establish fair values. And yet what you have there are 10 examples from just 2013. There are plenty more, I assure you, which rather undermine, don't they, the effectiveness of using market-based, mark-to-market or fair values? Okay, so we've been through the first three sins. We can have a quick recap. We've dealt with the fact that the accounting profession escaped any form of argument against complicity in the financial crisis of 2008. Whether it will do so again, don't know, but there's certainly people, doom and gloom merchants out there, pointing that if it does happen again, next time the accountants will be in the firing line over the subjectivity of values. We then looked at MB and we looked at the conceptual framework and the revisions that are going on with it, the economic focus in that conceptual framework, as with the original one. But the pursuit of this conceptual framework ignores the evidence in the literature about the functional failure of that. And I've given the example of how we're actually implementing accounting standards before we even think about the conceptual framework. And then under the sin of lust, we looked at markets, how they're operating, how she can behave badly or she goes missing. In the case of the examples you've just seen about how she's behaving badly or the people who are manipulating are behaving badly. And so I have very serious stats, as you can see, about the effective operation of fair values. But the accounting profession is not a lazy profession, far from it, and it's a very astute profession indeed. And it's aware of these issues, and yet it's still pressing on. And no doubt there will be a revision to the conceptual framework, and it will come out. And we've seen revisions as evidence in IAS 1 towards a greater use of reporting valuation movements. So very proactive conduct, and it has a Hicksian conceptual framework underpinning it, an economic framework. So it's full steam ahead, that's for sure. Very proactive conduct, but so what sin is this? Sin of sloth, obviously, that's a big sloth I had in the middle. In failing to report capital sources independently of income and vice versa. Here's an example. This is actually an example of capital alienation, where you have a capital source, but you choose not to use it. And it rather breaks the link between capital and income. And that's a very, very firmly established link in accountancy. I think we should report it. I think we should put evidences in the statements which may not necessarily produce an income flow, but is certainly a source of capital, valuable source. We may not choose to use it, but we can hold it. And we should report on it if we are doing so. Conversely, income flows exist, but there's no related capital value to those parties who provide their capital freely. That paper you've got tonight, that's my intellectual capital given to you freely. And you'll take it away and there's no income earned from it. If that paper ever gets published, and I hope with your comments, hopefully by the end of this evening, it will eventually be so, then I won't see any income from that, despite the energy and the effort that I will have gone to. So there we have an income flow which the publisher will get, and they certainly can't publish without my intellectual input, but my capital's not being recognised. Of course, that's very much an intellectual capital view rather than a financial capital view of the business. From the publisher's point of view, they will be investing in printing machines and so on to actually then yield an income. But if you look at it, there's a source of capital here, an intellectual source of capital, which hasn't been recognised. And there are people out there who are saying it's a long time that it should be. Because what's happening with a lot of these things is that it's affecting the middle classes quite badly. People are giving over their intellectual capital freely, and there's no compensation for it whatsoever. There's effort, energy and effort going out to it, but it's not leading to a wide dissemination of wealth in society. On the contrary, it's being narrowed. So if you look at something like Facebook, for example, then people are freely putting a form of intellectual capital there. Some of it's rubbish, of course, but a large part probably. But there's information there which can be used, and it is used, and the wealth goes to very few people, not the people actually putting their contribution there. If you look at something like YouTube, I'm told that it's a sort of compromised position where people will put their downloads, and if it goes viral, then they'll get some form of income out of it. But the hit rate count has to go over a certain threshold before they will get income. But what's happening is that an awful lot of capital, particularly intellectual capital, is being provided in free of charge. And people are earning income from it, but it isn't the people who are providing the capital. And those who are doing so, they're rent seekers, not profit seekers. They make no contribution whatsoever to the intellectual capital base. They take what you've got and they earn money from it. I'll give you time to read this. So the argument goes that, as the song told you, the poor are getting poorer and the rich are getting richer, but the middle classes in the middle are also getting squeezed big time. And we as a society and we as accountants, I think, need to start thinking about strategies as to how we address that wealth inequality. And this is the point I'm making, basically, now that sloth is... you can't really accuse the accounting profession of sloth. What I'm doing is I'm accusing the accounting profession of sloth by omission, effectively, by not being proactive and responding to sources of capital which have no income and sources of income which have no capital. And we have to question whether we're in the economic theory business, because when we look at, as we'll see in a few slides' time, the relationship of capital and income, it's based on Fisher, Irving Fisher, turn of the 20th century, about 1906, I think it is. Very, very firmly established in the economic literature, and it's very firmly established in accountancies as well. And when I show you examples of where the linkage between income and capital is broken, either where we have income flows and no capital, or capital and no income flows, that very basic economic foundation is under threat. And if my arguments are correct, then taken to its logical conclusion, we start reporting things which fall outside that normal capital to income relationship. So, we've had quite a strong argument against the marketplace and the manipulations there. The fact that we assume in our economic model that there's a relationship, a cause and effect relationship between capital and income flows. And for the most part there is, but there are plenty of examples where it breaks down too. And I seriously question when we say that we are supposed to faithfully represent financial reality, whether we're actually doing so. And we go right the way back to that Hieronymus Bosch painting, which is an allegorical representation, and we too are doing a representation, but to argue that it's a faithful representation is questionable, frankly, and certainly through the use of fair values, it's going to get more and more subjective, too subjective. That's my argument anyway. Yeah, that's a question that you can answer now. I've done all the talking. Consider too, not just what is missing from the balance sheet. So I would report, for example, capital alienation, because I think it's important to identify a source of capital even if you're not going to actually use it. But what about items which are actually already in the balance sheet and shouldn't be there, in your opinion, that they really, their capital status as assets is questionable? Can anybody think of one? I can think of a big one. Sorry? Aspects of it, I would agree with that. Yeah, I was looking at Rolls-Royce's balance sheet a couple of years back, and you see these white hairs. I can remember back in the late 1970s where they were developing the RB211 Rolls-Royce air engine, and they used to capitalize development costs, and they capitalized it to an extent whereby people started to question whether the RB211 engine would ever get built, and they actually went bust and were rescued by the Labour government at that time. And of course it turned out to be a world beater, and there are successive engines like the Trent engines which have come to fruition as a result of that development program. But yeah, they were building up development costs big time. They were building up expenses as assets. Yeah, and the same, I've looked at Rolls-Royce, they're doing the same again. It's quite interesting. So it's not one which would have immediately come to mind, but yeah, I have some sympathy with that viewpoint. Any other assets capital-based assets you think shouldn't be in the balance sheet? Goodwill. Yeah, that's the big one. It's got to be Goodwill. Goodwill, just... I can give a whole lecture on that if you want. Goodwill, yeah. We take one figure, yeah. First of all, it's entirely measurement-based, isn't it? We don't actually ever recognize the substance of it. We don't really know what it is. We simply take one measurement from another measurement, and the difference, or the defined excess, to use IFRS 3, is our asset. I mean, the amazing thing about it, and here's a prediction for the future, yeah, we stopped writing off against reserves because the level of goodwill got so great that we actually had the concept of negative reserves, which is bizarre, negative sources of finance, but that's exactly what was happening. And so we go with the international norm because that's what drove the process. I said the conceptual foundations of accountants, we are muggles. Well, the decision to actually switch from reserve write-off to asset was a political decision. It was driven by wanting to be part of the international norm. Everybody else was capitalising goodwill as an asset. We must do the same. Yeah? And when they did switch, the options given to you were 2 to 3, 6 choices. 2 elimination methods or 3 capitalisation type methods. We chose the capitalisation route. But nobody ever presented the argument at the conceptual level, are we actually dealing with an asset here? Everything was measurement-centred. So yeah, I have really serious doubts about goodwill, and the problem with it is it's like to be a burgeoning asset to the point where in some balance sheets it dominates, and somebody at some point in time hopefully will say, well, what exactly is that, please? There's an awful lot of money in it. What is it? So yeah, I'm with you on goodwill. I can think of just one more. Sorry? Patents. No, not really. Not if you bought it and it's been transacted for. I think you can have a patent and you can sell it in its own right. You don't even need to do anything with it really with some patents. So, for example, I'm a world-renowned cancer-curing professor, and I've got a formula on a piece of paper. Patent the idea of this formula. I think if I said I'm going to charge you £500,000 just to look at it, you might just pay it. So no, I think it can have huge value. And the example I've given in the lecture about an oil-rich sheik having a cold fusion patent, yeah, that cold fusion patent would be massively valuable because you'd have limitless energy. Yeah, it's just that he decides to alienate it because he also has a lot of oil deposits, and he's going to use those first. I think we should report that capital source as being valuable. It's just that it's not producing any income for us because somebody's deliberately alienated. So no, I disagree with him, but thank you for your contribution. I can think of one more. The only other one I can think of is footballer transfer fees. You're going to mention that, were you? Yeah, that's the only other one I can think of because I believe that they are surrogates for human capital. And I don't think we should be capitalising human capital at all. Now, that's a very interesting issue, isn't it? Yeah. How many times do you read on a company statement which says our most valuable asset are our people? Yeah. We don't put them on the balance sheet. And for good reason, in my opinion, because unless you believe in slavery, I don't think you should do. We can certainly put on the balance sheet that which people produce, but I'd be very hesitant about actually putting people on the balance sheet. But can you see that, we've got... talked about an example where we have capital and no income, an example of where we have income and no capital, but we also have, in my opinion, assets on the balance sheet which shouldn't be there, in my opinion. And we talk about painting a faithful representation of reality. What's this one? Gluttony, I think, yes. Anybody? 10 points for anybody who can guess which film it's from. Meaning of Life, well done, yeah. It's it's hilarious. It's John Cleese, who's the waiter trying to feed this guy to death, literally to death. He explodes, in fact. And he's feeding him his last mint. It's a wafer-thin mint. You must have it, sir. And with it, he explodes. Yes, it's very funny, really. Gluttony. And so we get on to this Fisher concept of capital and income flow. And from Fisher's point of view, it's all the same sort of source. And accountants have a lot of sympathy with this, don't they? The relationship between capital and income is almost interchangeable in some ways. And I sort of had a eureka moment in the bath this morning. As I said, this paper is ongoing. And I thought about this. I thought, how am I actually going to talk about this? Well, the paper refers to real, productive operating cycles. Okay, so let's take it one step at a time. If it's real, so if we have a plan for machinery, it's real. It's productive. So I employ this plant, this capital investment, to produce products which I then sell. And if I make a profit on it, I can feed that profit back into expanding the capital base, and it becomes a virtuous, real, productive operating cycle. And it's a profit-seeking cycle. So I thought, okay, well, let's go one step further. Let's have a real, non-productive cycle. So I thought, real, okay, that can be a building. Non-productive, I can have rent income on it. So I have rent income. Okay? Non-productive in the sense that my gain as the person who owns the property is your loss because you pay me. So the sum total of wealth in society doesn't go up. So it's non-productive in that sense. It is a rent-seeking cycle. It is a rent-seeking cycle. Non-productive. So it's got a capital base to it, but the income base, the income flow is a rent-seeking cycle. Okay, so I thought, well, can we play with this even more? Can we have non-real, productive? Yeah? Can we have a situation where we have income flows, no capital? Well, from a measurement point of view, we certainly can. Because we do it with discounted cash flow, don't we? Yeah, we take all those future income flows, discount them, and say we have a present value equivalent, which we can compare to the capital investment. So we're actually doing it in terms of methods. That's why I hate the method with a passion. I think it's so wrong. But anyway, can we have income flows? Yes, we can. Yeah, the robber barons of old would set up a toll on a road and charge a toll, get an income flow. They made no contribution to the maintenance of the road. There's no capital base, but they certainly got income out of it. My house, which is a tiny little mid-terrace mud hut in Hitchin, is tithed to the local church. The local church can charge income, a rental on me. If they want to, thank goodness they don't. Okay? But they made no contribution to my capital base, yet they can rent seek so that they can get income flows. Okay? I'm going to get really controversial now and probably upset a few people. I have no idea. I'm hoping somebody might have an idea. What about the Duchy of Cornwall? Does the prince actually own all the properties on which he charges rent? In which case that is a real non-productive operating cycle. Or does the prince have the legal right to put a surcharge in the same way as Church of England does on my property on all the people in the Duchy of Cornwall? Because if that's the case, then we've definitely got income and no capital. And there's a fourth level. As I said, it was a eureka moment. Not quite Archimedes, but it was getting there. Okay. So the last bit is, can you have no capital, no income? And the answer is yes, in which case you don't have an asset. That's fine. That's an easy one. But those four items which I was thinking about in the bath this morning, what a sad little world I live in. They sort of give you examples of where the relationship of capital to income is not as firm as you expect, as that suggests. And you see why I hate discounted cash flow big time. I think it's a very dangerous creature. But I've already shown many examples where this causal relationship broken down, and I've just been through a discussion of the possibilities that exist. Are we as accountants too bothered about whether it's profit-seeking or rent-seeking? No. We just record the transactions. Okay. Now it gets tricky. Because if you read that, and it is in the paper, and I'm struggling with it big time, this is why I need your help, that looks pretty nonsensical. So I'll give you time to read it. So if you're going to hammer me tonight, that's the one to hammer on, I can assure you. Okay, ready? This is my thinking, for what it's worth. I'm a bank, I raise asset, my credit, I get money from my shareholders. I take that money and I convert it into a long-term debtor by giving somebody the money to buy a property. And what happens is I have security on the property, and I now have a long-term debtor who will pay me principal interest over a very long period of time, and the principal payments will go down, will slowly increase the bank account, and my indebtedness will go down. Pretty virtuous, normal banking cycle, and the banking industry is essentially about managing the spread of risk between what I have to pay out in terms of maintaining our capital, particularly in terms of dividends, and what I can actually get from those people to whom I lend money to. Okay. It's actually a rent-seeking cycle rather than profit-seeking cycle, but fine, it has to be done because the banks provide the lifeblood of any business through the medium of cash. Okay, right. So let's deal with a model dealing with hypothecation. So I take all those payments and I bundle them up into a market-based security, a derivative financial instrument. Derivative in the sense that it derives its value from the underlying property. So I now have a financial asset, and on the other side of the balance sheet, I have a financial liability, and that's hypothecation. So let's stop there for a minute. By effectively securitizing all those payments, because that's what I've done, there's no new money's come in, we haven't got new deposits, it's simply securitizing the existing asset base. I preempted the realization concept. I thought it's conflation, but it isn't conflation. You still get the payments. But I preempted that by taking all those future incomes that I will get from the interest payments, and putting them into a package now. So what about the other side of the balance sheet? We've got all the money now, but what about the other side of the balance sheet? Well, all those successive points of realization where we have interest payment, income, profit, interest payment, income, profit, interest payment, income, profit, month by month by month, year by year by year, all those successive points have been conflated, no, that's wrong, have been preempted by creating the mortgage-backed security. Instead of waiting for all those incomes to come in and therefore swell the profit on this side of the balance sheet, what we have instead is a liability, a financial liability. So on this side of the balance sheet, effectively what's happened is I've taken all those future incomes and converted them into a liability. So I've deliberately introduced risk, and I have a long-term liability, which if it goes belly up, I pass on to somebody else. I find that morally repugnant personally. But I suppose at least you can argue with hypothecation, there is an asset base to which it's attached in some way. But I don't like it really in principle. I can understand why you do it, and there is some connection, obviously, to the underlying asset. But as we all know, in the 2008 crisis, those mortgagors defaulted on their payment, and you're still left with a liability. And the asset value base went down, fair valued, and we exacerbated it in pro-cyclicality terms, but it was quite a calamity. Okay, that's hypothecation. Re-hypothecation, then. This is where it gets tricky. Okay, I look at the asset base, the underlying asset, and I say, well, I've got collateral there. So what I'll do is I'll raise loans multiple times on the basis of that collateral. I'll get other people to do it through intermediaries. And so you can develop financial instruments like collateralized, as the name suggests, debt obligations. So you can generate a financial asset, and you're generating a financial liability at the same time. And you can flog that off and get cash, great, you convert it into cash. And I thought, I can't get my head around this. So I thought about it, well, we have the debit and credit, we have a transaction, Do we have it conceptually? Well, yeah, if you look at the latest conceptual framework, an asset is defined in terms of an economic resource. You then look to measure that resource, and the measurement basis refer to cash flows. So if you take the causal link, cash flows are the purest asset that you can get. And if you have a mortgage-backed security which you've flogged off to the Bank of England under quantitative easing, or a CDO where you've flogged off to somebody else, you've got cash. You've got an asset. So the accountants are doing nothing wrong in terms of recording the debit and credit in terms of assets and liabilities. Yeah. You then look at IFRS 9, is it? And you look at the various types. There's 4 types of financial instruments, whether it's over-the-counter or held for investment or whatever it is. And you say it fits into that category, so it now complies with IFRS 9. And if it's fair value based, you look at IFRS 13 and say, well, yep, there's a ready market out there. The banking industry, the finance industry has created that market. So there are market values. Yeah, is this level 1 or level 2? But I can put a fair value on it. Everything seems to be honky-dory. But it's money printing, isn't it? We've just pressed a debit and credit, created a financial asset and financial liability. Yeah? I was reading an article which was referring to Friedrich Hayek, I can't even pronounce his name, who was saying that these collateralized debt obligations, these financial instruments, you don't even need to convert them to cash. They're actually being traded as if they were cash in the financial markets. But this is why I need your help. I can't get my head around this because, as far as I'm concerned, they just pressed the debit and credit button and they're actually printing money, in effect. If that's true, we are complicit, in my opinion, in the biggest fraud that has ever been perpetrated on mankind. We're complicit by accommodation. Accommodation in our accounting standards, accounting in our conceptual framework. And we shouldn't be. Now, when I was sitting where you were sitting, a young man, it's back in the heady days of Margaret Thatcher, and we had Milton Friedman economics. And the little I know about economics, and it is very little, if you print more money, you just get inflation. So I thought, well, where's it going? So I started reading up about that as well. And one half of this quantitative easing, this money printing to back these financial assets, it goes into property. So we have a rent-seeking cycle there, pure and simple, no profit-seeking cycle. So half the money's going there, and that's why over the last year property prices have gone up by 7%. It's not cost-push inflation. There's no real increase in wages. We all know that, don't we? Yeah? Yeah. So it's being fueled by debt, and it's being fueled by quantitative easing. And those who can afford it, in other words, those who get access to this cheap money, very cheap money indeed, yeah, are getting rich, very rich. So the property prices in London in particular have gone through the roof because they're realizing that someday the train's going to hit the buffer, and let's pile into property. So half is going of this pressing the debit credit button, if I'm right, is going into property assets. 1/6 is going into a real productive operating cycle. So it's going in proper investment. Yeah, and 1/3, roughly, is staying within the financial industry. It's being pumped around, basically. And there are those out there like Max Kaiser, if you watch him on TV, who's arguing that basically we have a massive Ponzi scheme because under the quantitative easing program we're pumping money in. They're buying not only the mortgage-backed security, but they're also buying the toxic ones. Yeah, they're just buying it to pump money in. That's a weird concept, don't you think? A toxic asset, isn't that a contradiction in terms? Yeah, I can understand a toxic liability, toxic asset anyway. So the money's being pumped in, they're buying up these financial instruments. But what's being bled out from this system is the fact that people are obviously charging transaction costs, making a nice big fat profit for the banks, and bonuses too. So the money's coming out too. And it's a Ponzi scheme because it's reliant upon money going in will replace the money going out. And it's no different than Bernie Madoff. Yeah? If you taper or switch the tap off, it'll collapse. But it's okay, because we as accountants can record it as a recognisable transaction and say that it was compliant with IFRS 9 financial instruments and it was properly fair valued and it's all right. Yeah, really? The first slide I put up was a quote from John F. Kennedy. The hottest places in hell are those reserved for those who, in the face of great moral crisis, do nothing. Now, I'm trying to do my little bit tonight, and I'm really quite ignorant. I hope I get some really searching questions. I may not have the answers, but I'm hoping other people here will have the answers, because I want to strengthen the basis for this paper which I produced, which you can take away, and by all means write to me if you think there's fundamental errors in it, in the reasoning that you've heard from me tonight. But if you can't find any fundamental errors in the reasoning which I presented to you tonight, it's a pretty poor show, isn't it? Here's a rather amusing quote. I will give you time to read it. It's from a guy called Mitch Firestein. It's a recent book he's written called Planet Ponzi. I'd recommend it, actually. It's a good read. But he's obviously convinced that all we're doing effectively with these financial instruments is money printing. So I told you about those 4 levels, how we gave an example of a real productive operating cycle, plant and machinery producing income, a real non-productive, which would be where you have, for example, a house and you get rent, you're a rent seeker. Yeah, and then we looked at other examples where you can get income and no capital base, where you're a true rent seeker. Okay, and it rather breaks the link between capital fund and income flow. And with this money printing, this is why I have difficulty getting my head around it, because is there any capital base here? Yeah, well, if you look at the definition of an asset, an asset is a resource, an economic resource, it must link to economics, an economic resource, and it must produce cash flows. But it seems to me that with rent-seeking financial instruments, all we're really doing is just pumping more flow in. Yeah? Look at it this way. I have a pig and you have 2 sheep. And I turn around to you and I say, I want 3 sheep. Yep, yeah, that's fair. But I don't have the 3rd sheep. So what I'll do is I'll give you a promissory note for the 3rd sheep. Okay? Now, it really doesn't matter to me whether you give me 1 note or 10 million notes. I want my sheep. Right? Because with my sheep, my source of capital, if you like, I can kill it and produce lamb chops and a woolly coat. Or I can get other sheep lambs out of it. But I can use it in a real productive operating cycle. Yeah? So it's a bit like the Germans at the moment. They're saying to the US, I want my gold back. Give me my gold back. No, sorry. I don't want your dollars. Please don't give me dollars. Give me gold. Give me something which is real, which gold's probably not that productive, but it's certainly very real, a lot real in paper. And what we have now is basically a heck of a lot of money printing. We seem to just have flow, either made from or added to flow. And under the heading of gluttony, we can say that rent-seeking is a gluttonous activity and that it tends to advantage the few at the expense of the many. And isn't that exactly what is happening at the moment? But to accountants, it's all just recordable transactions. As I said, it's compliant with IFRS 9, IFRS 13, all the best. See you. It's transaction-based. It seems to meet the definition of an asset. We can go ahead with it. Here's another quote. I'm sorry it's so small. Hopefully you can just about read it. It's by Robert Schiller again, the guy who was author of that Irrational Exuberance book I was referring to. Excellent read, by the way, an easy read as well. Well worth getting it. Well, I talked about market manipulations and the effectiveness of the market. This argument which you're reading there is about the rent-seeking nature of an awful lot of transactions which go on in the marketplace. Is that okay? Yep. Okay, so that's dealt with the gluttony. Let's move on to greed. 2 more to go. That's it. Greed and pride next. So let's get back to this, the starting idea about whether as accountants we're actually producing a faithful representation of reality in the way that Hieronymus Bosch did with his painting. And a faithful representation, according to Lace's discussion paper on the conceptual framework, is one which is free from error. And if you read a little bit later on, it says, in this regard, measurement estimates can be a faithful representation if the reporting entity has a properly applied and appropriate process. And isn't that what I've just been talking about? Yeah. We look at the transaction, debit and credit is transaction-based. It seems to comply with the definition of the asset. We look at IFRS 9, it complies with that. We look at IFRS 13, it complies with that. And we say to ourselves, it's a faithful representation because we follow the appropriate process. But it's a flawed one. We seem to be holding a rather selective view on the way that we're actually going to represent financial reality to those who use published financial statements. Questions for you to ponder over as a result. Public interest standard is a very interesting one because it's not an absolute one, it's a relative one. It's very difficult to actually nail it down. So accountants, according to Wilmot, ascribe to the view that, well, by serving the interest of investors, we serve the wider public interest. I have to question that, but that's one argument. And the last sin now, pride, you'll be glad to hear. Okay. So we have an economic focus, an economic orientation, a mark-to-market based view of measurements in accountancy, where we can get them. And I've shown you a lot of argument this evening which questions that quite seriously. And I think we should swallow our economic pride and declare to the world that our representation is effectively a self-referential one. It's what we say it is. And if we can, closer we get to transactions, the purer it is, as far as I'm concerned. Think about it. It's what I refer to as state tracking systems. If it's transaction-based, you can track on a one-to-one basis from the external environment into the accounting system. And it's the same with the stock market system. It's a state tracking system. You can track stock market prices. You can track what goes in to move the price. But accounting systems, they would like to be close to that market-based economic viewpoint, that hard, factual, almost concrete system. Yeah, but accountancy is not like that. It's a modified transaction-based cost, and we modify it even more through the usage of valuations. But in essence, the epistemology which is driving accountancy is a rule-based social construction. Yeah? It's driven by definitions and it's driven by rules. It's a very social animal. It's very politically driven. That's why you can change the rules and make Goodwill a non-asset 1 year and an asset the next year. And nobody even blinked. So my argument is that accountancy really, forget conceptual foundations, it's really about a craft. It's really about a craft with rules as to how that craft could be conducted. And you accept it on a self-referential basis. this is the way that we've set up the rules, this is the way we intend to construct it, take or leave it. We know it's always incomplete, but it's the best that we can do. And I think Raymond has a pretty good idea about actually having a pure transaction-based. That's a state tracking system, yeah? Hard facts. I think the analysts would like that one a lot. And then we have a second column, which is basically to do with valuations and how we're going to actually paint the picture, inclusive in valuations. But we acknowledge it's a self-referential one. Forget trying to reference it against the economic market-based viewpoint, because it's flawed big time. And arguably with a craft, one does not need a conceptual framework. And it's something certainly for the ISB to start thinking about. And that brings it to a conclusion. I hope you enjoyed it. It sounds to me like you're pretty stunned. Certainly very controversial. You may not accept all the points. Certainly if you have an intellectual challenge to what you've heard and what you read in the paper, please raise it with me, because I need to strengthen that paper. So, for example, the argument I put about the 4 levels for income capital, yeah, that's not in the paper. It's something, as I said, I thought about in the bath this morning. It will go in the paper, but if you've got any views, any questions, now's your time to ask. And I think at this point we have microphones, don't we? We're certainly all stunned.
I'll start off, Tony, if that's okay.
Remember, I don't have all the answers, but I'll do my best for you.
It's very, very interesting, very stimulating. I just can't help but think about those transactions that you talked about at the centre of the talk that you just don't like the CDOs. You were quite clear that you just didn't like them.
Money printing.
But I guess they're going to happen because they, banks, traders, these things happen. So my question would be is, you don't like them and you don't like the accounting that follows from them, but I guess because they're going to happen, what are you going to do from a reporting point of view if they are going to happen?
I'll go right there.
If that makes any sense.
No, it does make sense. But that's an argument to maintain status quo, to maintain the inertia. Yeah, and it's going to hit the buffers, in my opinion. And when it does, people will rightly say, well, didn't the accountants know about it? It's complying with everything in accountancy. Yeah, but why do we allow it to happen? Where's the professional skepticism here? We can say it's compliant within the picture that we paint. The picture that we paint is governed by IFRS 9, IFRS 13, the conceptual framework, it's transaction-based, it seems to behave like cash, so it complies with that. It's got everything going for it in accounting terms, but the actual substance of it isn't there, is it? To repeat, I give you my pig for your 3 sheep, but you've only got 2, so you give me a promissory note. I don't care whether you give me 10 million promissory notes. I want my sheep. And what we're arguing for is that we maintain the promissory notes. We carry on printing the money. It's not actually backing any form of wealth, is it? Yeah? But we account for it, and we are complicit by accommodation. No disrespect, I'm getting a bit passionate here, but what you're arguing for is to maintain that complicity. Yeah? And the whole point of this lecture is to say the faithful representation that we are purportedly portraying will eventually collapse. Because it's a giant Ponzi scheme. As long as you keep pumping the money in through quantity easy, fine. But the minute it stops, there's a considerable danger it will collapse because it's being bled out. Sorry.
But is it the complicity by allowing the transaction in the first place, or is it in the way that it's accounted for and reported, or both?
Whoa. That's one hell of a question. We don't make any distinctions between profit-seeking cycles and rent-seeking cycles in accountancy. Yeah, and I suppose when you come to real productive and real unproductive, at least you have the real bit, which is an asset base. The minute that becomes non-real productive, you're talking about that income flow. Yeah, where it's just going around, and it will collapse eventually because it's just money printing. Yeah, and I think that has to be challenged. How you challenge it, which is your question, I ain't got a clue, mate. All right, but one of the reasons why I stuck my neck out tonight, and let's face it, I have, haven't I? Big time. yeah, is because I can't stand on the sidelines anymore. That's why I put that first slide up. Yeah, I don't mind being shot down in flames, that's fine if there's a reasoned basis to it. But if what I'm reading is correct, then yeah, we can't go along with it. We have to find some way through our regulatory structures or by auditing or whatever mechanism. I don't know, I can't answer your question. But I think we need to try and call a halt to it. Yeah. Are these banks really solvent if all they're doing is printing money, effectively? And why do you think the deposits have switched away from banks? Well, apparently they've lost about 2.5 million deposits in the last year. And the banks are very alarmed about that because they're losing, people are bringing in fresh money, yeah, which is a good source of money. Instead, what they're doing is securitizing instead, yeah, using the asset base to print the money. That's not a good way to conduct business for a bank, in my opinion. It's a good question. I don't have a full answer to it. I wish I did. You know, I'm putting it out there in the hopes that it rings enough alarm bells that people, brighter people than me, will actually formulate a response to it.
Yes, my question just sort of follows on from that, actually. It was thinking about the role of the regulatory bodies, and you mentioned quantitative easing. I mean, the Bank of England is responsible for that, so what would be your message to Mark Carney?
God, there's some hard questions here tonight. That's almost impossible questions. If he will eventually taper, he eventually will turn off the tap, so I'm told. But when that happened with Bernie Madoff, yeah, the whole Ponzi scheme collapsed. He ended up in jail. So if all we're doing is feeding money in, so let's go through it again, rehypothecation. We take the underlying asset and we take the collateral there and we raise loads and loads of loans on it. So we've now got money, or rather we've got financial instruments, financial assets, and we've got financial liability at the same time. And if we convert that into cash, if we can flog it off to the Bank of England and the quantitative easing program, we can argue that we've actually got cash too. All right? But that's just money going into the system. It's not necessarily chasing any real wealth. It's just more money going in. And that's fine, but we also know that money's being bled out in terms of transaction costs and in terms of bonuses paid to people. And you've seen many examples of the corruption which has been going on. But if that's the case, it means that the net cash flow in this cycle is declining. So if you stop the input of cash, then it's a Ponzi scheme that will eventually just go bang, collapse. I believe it would happen quite suddenly. So, Mark Carney, somehow they're going to have to take this problem and address it. And your question is really no different than the question over here. Yeah, I don't have all the answers to that. You're really talking about large macroeconomic problems. My issue tonight, my approach has been very accounting-centered. You know, what are the accounting entries? What's happening here? Trying to understand it. Yeah, to actually say, well, hang on a second, is this a faithful representation of financial reality we're painting because we're allowing this by accommodation? And what are we going to do about it from an accounting point of view? The questions, first questions tonight have been really about macroeconomic responses to it, and that's, I'm afraid it's well beyond me. As I said to you right at the very beginning of this lecture, there'll be questions for which I don't have the full answer. Does anybody else have an answer to it? What should Mark Carney do?
Well, I did begin by talking about the regulatory bodies, so, as accountants we have...
Well, that's no different. I mean, I'm putting the question out there, I'm looking for answers, and you're saying, please provide me with the answers. I don't have it. I'm being truthful, but I don't. All I know is that I'm trying to understand the accounting entries. I'm trying to understand whether by what we're doing we're faithfully representing reality, financial reality, in our portrayal of that in the financial statements. And the argument I'm putting is that the way that we're painting it is wrong. We need to look at it again. And I think you've already seen alarm signals in that quote I gave you from the FRC and the use of professional skepticism to be exercised here. I think the FRC and the regulatory bodies are very much aware of what's going on, but there's no response to it at the moment. It's simply transaction-based, it complies with the definition of asset, it complies with IFRS 9, it complies with IRS 13, therefore we're doing the right thing. But we're not. We're not really representing any sort of real wealth. All we're representing is monetary wealth, and that's accommodated. Any other questions? Stunned silence. Oh, no, good.
Just a question on the asset value of money itself. Because I think, I don't know, my thoughts are that the asset value of money per se is related to the confidence that we have. I mean, I remember in the olden days when a pound was worth a pound of gold. But let's assume that I have a pound of gold. How much, or how many assets is that worth? And I think it's to do with confidence, isn't it?
No, I would get the basis on which you base the question, which is the asset value of money. Money is simply the means by which exchange is facilitated. Yeah? It is a deferral between one transaction and the next. If I can, I'll trade my 1 pig for 3 sheep. I don't need money. Yes. Right? It's simply because I have a deferral. Yeah, I can't get it now. I have to wait to facilitate that transaction, that we have the medium of money. So money, the only function of money, is to actually facilitate transactions. Have too much, and you just simply have too much money, the price typically goes up.
But my argument goes back, and I know I'm not an expert in the field.
Join the club.
Goes back to economics itself. Because if we look at the accelerator effect of money, the value is determined at the point where we hold the gold. If I've got a pound of gold and I buy one, it's worth one sheep. Then I buy 1 sheep, the next person can buy a sheep, the next person can buy a sheep, and the number of sheep that gold is worth only stops when the last person doesn't buy. You should see what I mean. So in terms of... Well,
aren't you putting an argument for moving back to the gold standard and so on, where you've got actually something which is backed by a sense of real worth?
But there's no real worth still, because the accelerator effect is telling you that the worth is in confidence. The worth is in the way the transactions go. So if that is the basis then probably as accountants, we should account for confidence. I don't know. I mean, that's just a thought.
Thank you for your contribution.
Mine's initially just a comment actually about around the morality of pricing, and you alluded to the footballer, which made me giggle because I'd written £1 million per footballer. How do we arrive at that, and why do we assume that if we pay more for something it's actually worth more?
Yeah.
But my concern, and a question which you may or may not know, is around that third that's recycling you talked about, and that's going back into the financial instruments. What do we know about that?
Well, although in terms of, you read that quote by Mitch Firestein about CDO squared, they're using the existing collateral base, so they're taking the underlying asset and using that as collateral to raise loads and loads of debts. Okay, so there's no real increase in wealth. All there is an increase in money. Okay, so you can actually use those collateralized debt obligations as effectively money in the financial accounting in the financial markets. So effectively, and an article I read which quoted Friedrich Hayek saying that's exactly what is happening. Effectively, those CDOs represent money, paper, okay, matched by liabilities. So that all that's happened is you've increased the flow. Okay, there's no real capital there. This is, I suppose, the dispute we're having as to whether paper actually represents value, money actually represents value. From an accounting point of view, I think the argument is it probably does. Right? But money, paper money, all it does at the end of the day is act in that promissory capacity about the mismatch between transactions. Yeah? And that's really its function. If you could get perfect bartering system, where everybody knew exactly what everything was worth and they could freely trade in it freely without interruption, you wouldn't need money at all. So it simply facilitates that process. So there's no real intrinsic value in money, it simply flows around. I don't know whether that answers your question.
It wasn't a very well-structured question, but I just think I worry consistently about that.
Yeah, I think you're right to be worried about that. My very limited understanding of that is that this pressing of the debit and credit button, I mean, this is right at the heart of that rehypothecation thing, when I said, if there's a problem with this paper, if you have to attack it, that's the place to attack it. So you're putting your finger right on the most sensitive button, Okay? But my understanding is they're literally pressing the debit and credit button, yeah, to actually raise this. They're doing worse than that, because my limited understanding is that under Basel III, you can raise financial liabilities to up to 97%. Can you believe that? 97% of the asset base. Yeah, and I don't know what that asset base comprises, by the way, but 97%. But with something like CDOs, or to use that Mitch Firestein example, CDO squared, where it's just gone bananas, yeah, and they're printing money like mad, they're actually conducting it through intermediaries, so it's not falling foul of Basel III in what's known as the shadow banking sector. I know absolutely nothing about it. For those of you who do, come and educate me. But all I know is that this is going on. Yeah, and it's been accommodated by what we do as accountants. That's why I'm here tonight, because it's accommodated. And I'm looking at it thinking, yeah, and am I the only person seeing the fact that the emperor has no clothes? Yeah, are we literally just printing money for what? And we're regarding this as wealth? Yeah, as assets to be recorded? No, I have real problems with that.
Historically, accountants have always hid behind the message, don't kill the messenger.
That was one of the very arguments used, yeah, in the paper, that please don't kill the messenger, yeah, we're only recording what the bankers have done, yeah. I think you get the counter-argument to that is that first slide from J.F. Kennedy, yeah. The hottest places in hell are reserved for those who in times of great moral crisis, and the way I'm viewing it, I regard it as a great moral crisis, maintain their neutrality. We say it's all compliant with our rules, this is a picture we want to present, but actually, taking this point about income flows, the picture we're presenting seems wrong to me.
Well, literally just today we had a conversation about the fact that as a profession we've been very fortunate, and it's recognized within the population that compared to solicitors, doctors, politicians, I mean they're long gone now, but estate agents, we are still trusted. And I think this paper that you've written is very timely.
Thank you for that.
It really is. And I think we need to make sure that our colleagues and peers are aware of the esteem that we're held in, and ensure that we do become the keepers of the gates. Professional skepticism, we shouldn't be embarrassed by it.
No, I agree with that fully. We're in an incredibly powerful position. Incredibly powerful position. When any calamity happens, for example, involving a bigger chartered accountancy firm like demise of Arthur Andersen, who do they get in to sort it out? They get accountants to sort accountants out. Why? Because the only other body which has the power to rival the accounting profession in the financial accounting domain, is the government. And they don't have that expertise, so they turn to the next powerful body, which is the accounting profession. So we're in an incredibly powerful and very privileged position in society. Yeah? And the public interest standard, the ideals to which we operate should be high ones. And I think by and large a lot of accountants do. I don't want to tar every accountant with this brush that I've been painted with tonight. But I'm glad you made that comment. I'm really delighted, because I couldn't agree with you more that actually, if what I've been speaking about tonight is true, then it's time to at least shout about it. But I don't have all the answers. The first two questions I couldn't answer because they dealt with macroeconomic issues. And I don't have a response to it, because you're talking about saying there's a problem. How do we sort it out? And all I'm doing tonight is saying, are you aware of the problem? Are you aware that the picture that we're painting, that the faithful representation of reality, of financial reality, isn't so faithfully represented as we'd like to think? So thank you for the question, and I agree with your comments.
Yeah, in the heart of your talk, you talked about the purity of the kind of real productive cycle, real capital generating real income.
It can never be exclusively that.
Yeah, theoretically. I was just struck, like many people today, by the WhatsApp Facebook transaction that was announced. Facebook acquiring this company that has this kind of mobile app, and the value of the transaction ascribed was $19 billion.
Wow.
principally because Facebook issued a load of stock for the acquisition, and it's all based on the market value of Facebook's stock. So to me, that's a massive example of how we just live in a completely changed world, because there aren't many tangible things that you can touch or feel or point to in that, around that transaction, around those businesses. So I just wondered.
But that wealth is going to very few people.
Yeah, correct. So I just wondered, what your thoughts were, on the.
Well, I can give you
how that transaction is described. In particular, the thing that made the press was this huge number, $19 billion, which is all market value based.
Again, it's about the future that you're asking about. There's a book which I have cited in the paper by Xavier Lanier, who's one of these sort of futurologists. And his argument is saying that with online facilities where the capital is provided freely by the people, but the owners are effectively rent seekers on the back of that free capital, that it's time to change that because it's decimating the middle classes. And his solution is that you basically have a hit rate tax, where people, when they're accessing your intellectual capital or whatever capital you deem to be valuable online, that you actually pay for it. So that you see the problem, the capitalist system only works correctly when there's a vast middle class, where there's a dissemination of wealth. And what we're seeing at the moment is the exact opposite. We're seeing the concentration of wealth in a few people's hands, the poor getting excessively poor, and the middle classes are getting, frankly, decimated slowly but surely. Yeah, and a lot of the bright ideas, the intellectual capital base, and the provision of the capital which fuels these online facilities is given for free. Yeah, and if you read the Lanier book, he's putting an argument saying, well, actually, it's time we actually spread that money around a bit, spread the wealth around about a bit. So his suggestion, I can only give you his suggestion, is that we sort of think about a hit rate tax for those people who are providing it. So we actually attempt through the very means that we use to spread it more widely. Can I go back to your point about fund flows? Yeah. Transaction-based state tracking systems are very effective and very powerful, aren't they? Yeah. If you can map from an external environment, a business transaction, into an accounting system on a one-to-one basis, like you could 500 years ago when we had transaction-based, that's a very powerful system, isn't it? Because you get a representation which is pretty accurate of what actually happened. Right? It's a state tracking system. When you get money printing of the sort of order that we've been talking about, yeah, it sort of breaks that down quite a lot. Yeah, you're into a valuation-based view of accounting, and what counts as an asset is now getting increasingly suspect. But as we know, there's been a development recently about cryptocurrencies, Bitcoin. Yeah, there are many versions of it, but Bitcoin, my limited understanding of it is that it's an algorithmically based currency. It has a maximum of 21 million coins, so the money supply is fixed. It's divisible by up to 8 digits, so it's quite big. I think it worked out 2.1 trillion possible transactions that you can have, which is huge. But it's a non-corruptible money supply. It takes printing out of it. It takes the entire central banking system out. It takes the banking system out almost, period, and you have peer-to-peer transactions using a monetary base which is fixed, yeah, and quite large. So it'll do the job all right. But the next step will be to put on top of this robust currency base, this electronic currency base, an accounting system which is transaction-based, because what you have with Bitcoins is every time you do a transaction, you have what's called the bit chain, which actually records all the transactions for posterity. So you have a full audit trail, so you simply put an accounting system on top, which is a pure transaction-based accounting system. Yeah? You get no corruption then. You get the same sort of one-to-one mapping that you get in a pure transaction-based system or pure stock market system. Yeah? It's trying to map what actually happened. So I don't know what the future's going to hold. Your questions have been about the future. But I look at the cryptocurrency issue with a very keen eye indeed. Because I think if that was in place, you wouldn't get the sort of money printing that we've got, period. Just a thought. Mm-hmm. Any other questions?
I think it's going back to the good point that you raised about trust. As an accounting team, we're the core of an organisation. But we create the trust so that people can rely on the decisions that we make. When you go externally, after the financial crisis of 2008, one of the things that the financial institutions try to do is to create more, I think, capital testing. And we're seeing a lot of that, especially in the organisation I'm in. And one of the things is that in terms of capital testing, it relies on the strength of your balance sheet. So it goes back to the fundamentals of what you've highlighted in terms of all those things happening in 2013. What is the point of it? It's the actual trust. So people are relying on that for their investments, their pensions. You're actually breaking the core if ultimately what your balance sheet is based on is fictitious.
I 100% agree. Listen, I've got these white hairs, and my pension fund. Yeah, okay. My pension fund, I just found out, is being managed by J.P. Morgan. I've got to be careful what I say about, defamatory statements. But you've seen a few J.P. Morgan quotes up there. Yeah, and I do worry about. I've actually looked at the investment profile, and there's quite a lot of equities in there, so it's not quite so bad. But I think if I was holding a heck of a lot of these financial derivatives, I'd be quite worried. And I don't know what's going to happen, but the song said everybody knows. Yeah, look, do you, like me, get the same sort of feeling that something's not quite right? Do you, like me, seem to get the sort of feeling that, this is a train that's going to crash? Because that's the way I feel. How about you? You see, I think the British public are pretty savvy. If we've got a mini boom at the moment, but no real increases in wages, how's it being funded? Well, I think what's happening is that they are spending from savings. And they may actually be refinancing, who knows, but I suspect they're spending from savings. And the reason why they're doing it is that they look at Cyprus and they say, I ain't going to hold on to much cash. What I want is something real. Give me my new car, because at least that's real. So my own view is that the British public are pretty savvy. They may not have the sort of knowledge base that you have and the sort of knowledge base I may have after doing lectures like this, but they intuitively feel, in my opinion, that something's wrong. Yeah? And that's why I think they're spending. I think it will be switched off. I don't know what's going to happen. You've asked questions and questions about what to do about it. Do you know what I think is going to happen? It will just collapse. And that what Iceland faced, we will face. And it will collapse, and we'll have to press the reset button and start something new. And what it's going to be will take far greater minds than I've got. And as regards my pension, we were talking about it before we even came here. I think there's a really good chance I won't be seeing it. Or a very small part of it. That's my view. It's a rather doomy and gloomy view. And I don't know where it's heading. You see, as I told you, I'm no finance expert, for sure. But I believe China is money printing like mad. And the way I viewed that, and this is just from a layman's point of view, I said my finance is very limited. I thought, well, if China's looking at America and the UK printing like mad, because at least with the paper you can start chasing real assets with it. And if you've got lots of pieces of paper, and you're super rich, you can chase even more assets. The rest of us can't. But keep on printing, keep on getting the money out there, because at least with this paper, if we can con somebody to exchange it for real assets, we'll do that. We'll invest it in gold. We'll invest it in property, which is what we're seeing in London. We'll invest it in fine art. We'll do everything which is real, whether it's productive or not. It's real because we know that it's going to hit the buffers, which I think is why China started printing as well, as if to say, let's join the club quickly. Let's start buying things in Africa using our yuan, and we'll print it to get it. Because this is a massive scramble for real resources. yeah, using paper, using printed money, using electronic money. And I think what will happen is that eventually it will hit the buffers, and that what typically happens, I'm told, from what I've read, is that there will be a financial crisis, which is 1/3 of that money printing. Yeah, that will then precipitate a housing market crisis, so that will start collapsing. And the article I read was rather doomy and gloomy because it said the next step is war. Hopefully it won't come to that. But I just think the British public are quite savvy. I think they have quite a strong feel about this, that something's not quite right. You know? I was chatting to the guy at the back, the guy who's filming us, and he had exactly that view. He knows nothing about accountancy, nothing about finance, and yet he was exactly of that view. He can read, as you just read in this lecture, about the newspaper articles, and he knows there's something wrong. Say it again.
Do you think that's why there's no political appetite? Because they know it's wrong.
Maybe so.
Or the devaluation question.
Well, it's fear of devaluation at the moment. They're busy printing like mad. Are we done, folks? Well, I hope you enjoyed it. It was certainly controversial, wasn't it? It's food for thought, but your point, take it out there. Thank you.
I'm sure you all enjoyed it. It was really good, and thank you for interacting and joining in.